Welcome to the Life Insurance Financial Education Podcast. We're pulling back the curtain on high cash value life insurance, revealing its role in a comprehensive financial strategy to help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
Hi, this is Jane with Tax Exempt Millionaire Club.
Hello, and I'm Carlo Vaquera with NetWealth Finance.
And today we have a continuation from last week's topic. Last week we talked about the benefits of specially designed high cash value life insurance, specifically whole life and IUL. And today we're going to talk about how do we decide what to choose? Which one do we want to use? What are the situations that we're going to encounter that tells us whether one or the other might be appropriate? I'm a fan of both. I think all of us are a fan of both products, but each one has a particular niche and might serve a client's needs a little bit differently. So to kick us off, let's go, Carlo. If you have a client in front of you and they said, I like the idea of high cash value life insurance, tax benefits, all the good stuff that we heard last week, but I don't know which one. I don't know whether to go IUL or whole life. How do you decide which one to recommend to them?
So I think there's a few different questions that I might ask. And one of the things that I will often think about is what does the person think about markets in general? If they're sort of anti-markets and just want something that's secure and safe, that is not correlated to the market, then whole life is a great tool for that purpose. For me personally, my own whole life, I look at it as what would replace any kind of bond instruments in my own portfolio. So if somebody's looking to replace bonds, CDs, high yield savings, these types of instruments, then whole life really fits that. If somebody's looking for growth and targeting for retirement income supplement, then IUL is likely going to have stronger growth in the long term. If properly designed, then IUL can be pretty great returns over the life of the policy. That's where it's obviously tied to the market. So if somebody's against that, then that's not necessarily for them. But I think IUL is a great tool for that. Also, if they're on the younger side, because that cost of insurance can be pretty low when they're young or even juvenile, then IUL can allow for some pretty big growth in those early years because that's where the cost of insurance can be really cheap. It's not to say that it doesn't work for folks that are a little bit older, but that's one of the places where, I might look to it. And then if we're looking for arbitrage directly in the policy, I think that's a big factor as well. If somebody wants to say, like, I'm going to borrow at 5%, it'd be really great if I see 8% crediting in my policy while I'm borrowing 5%. That's an example of where IUL is much more likely to have that scenario. That's where you would have that advantage for an IUL. So there's so many factors, and I could go on for a long time, so I don't want to take up too much on this, but that's kind of a starting point of how I like to think about which product is better for a given person's situation.
Thanks for sharing. There's definitely some things to think about. Jing, same question to you. When you're sitting with a client and they're not sure which one, because sometimes a client will come in and they'll have an idea of which one they like, right? Sometimes they come in and they say, I'm interested in an IUL or I'm interested in a whole life. When they're not, how do you decide?
I will start with asking the client to think about the main purpose. For us practicing IBC, infinite banking concept, we probably want to own multiple policies. I want the client to think about this particular policy. Do you want to have that practicing that IBC versus just for your retirement? You have just buy it, set it, and then just instead of managing it, like what we mentioned, the different features of IUL, there's some index fund, you probably need to review it. We all know both of them permanent life insurance policies. Both of them offer a lot of guarantees. But I think the main thing is about the flexible premium versus the fixed premium. It has to fit into your funding structure. What's your plan? It goes back to the main purpose of buying this particular life insurance or different life insurance policies. Also, we mentioned about the return, right? For whole life, it's the dividends and you become the shareholder of the life insurance company. And then there's a lot of higher potential returns for IUL, as we mentioned last episode. I think there's like what Carlo just mentioned, there are just so many factors we need to consider for whole life versus IUL, what's the most important thing to you at that moment, how this particular policy will fit into your overall funding structure, your asset allocation. Also, remember, we mentioned the higher potential of arbitrage of your money when you purchase IUL versus whole life.
So this is a conversation that I have all the time with clients. We do get clients that come in and want one way or the other, but a lot of times they just like the concept. And so where do we start from, right? The first question that I want to find out is, where does this need to fit with the rest of your financial plan? So I usually will just ask a client, paint me a picture of all of your finances, and I can take that picture and we can help identify which product is going to help best meet any gaps that we can identify there. Along the lines with what Carlos said, I do look at whole life as more of a savings alternative, bond alternative, some nice safe aspect that we know is going to go up all the time. It can also work good for people that just have an aversion to the stock market. If they're not interested, if they don't want to participate in the ups and downs of the stock market, in the IUL, even though we have downside protection, you're going to get some people that get a little queasy when there's a 0 year. So yes, they're not losing money, but it might still be too much risk and too much volatility, even between 0 and whatever the positives are, for some people to stomach. Where is it going to fit? What's our financial plan? And where are the gaps at? And then also I like to look at what type of risks are we taking inside of our other investments. Maybe we have a situation where a client has a lot of risk in either their main job or their main investments, where these investments carry a higher level of risk than, say, just investing in a low-cost ETF. We don't necessarily want to pair a really high-risk portfolio with the IUL that carries some risk with it as well. It actually can be a really good pairing to pair that with whole life. Now, as Jing mentioned, a lot of times people are going to end up buying multiple policies. So this might just be where we start out. And there's almost never a bad reason to start with whole life. Whole life can be that nice, safe place to launch from. So taking the whole picture into account, obviously we'll make a recommendation and the client's going to have to help decide which one they're comfortable with. One thing that Carlo mentioned is kind of key as well, because when I have a client mention that they're looking at some type of a policy for their child, I always like it. It's the cost of insurance is so inexpensive in the early years on those. And we can fund them at a nice high level for a long, long, long time. And so if we can get 60, 70 years of compounding, what I like to think of is we probably expect an internal rate of return between 4 to 6% inside of whole life. And in the IUL will probably be 5 to 7. Not a whole lot more than whole life, but 1% extra over 60, 70 years of compounding is a lot of money. And when we start off with those lower expenses as well, that can also translate into a lot more dollars early on that's growing and compounding. A lot of things to take into consideration. Anything else you guys want to add? Or did I trigger anything that maybe you thought, oh yeah, good point?
I mean, I think that's a solid thing that you pointed out there with regards to the juveniles. When you have that low cost of insurance, that amount of time, that 1-2% extra can really add up over that amount of time. And so that's a really powerful thing for those juvenile policies and an IUL.
Another thing I want to mention is about where you are on your health, right? Since not everybody is in the perfect health situation when they want to shop around and learn more about life insurance. If your health is in the perfect condition, sometimes you're stretching out and then you go in with a pretty high premium. And then if you look at the term, you will notice different rating will give you extremely different premium. And then I think if your health is in I just say it because my situation, for me, if I go with whole life, the cost of insurance from day one, from the first year, all the way till 105, based on different carriers, it will be stretching out flat and it will be very high. But I need that flexibility. I need to put the money in, pull it out as a loan and do real estate investment, buy and sell business. So I need that flexibility. For me, the lower cost of insurance is very important. to have that compounding day one to really inside of this policy, the money can work for me.
Great points, Jing. Because one thing that none of us mentioned in that first go around was health and age. Health and age can definitely make a big difference with which product we might recommend. I can think of some older folks that we've went right to whole life because it really doesn't make sense to have the much higher cost of annual renewable term insurance if you're in your late 60s, sometimes even early 60s. It depends on the funding level that the client is trying to do. But that annual renewable term insurance inside an IUL gets expensive. It's all relative, but it tends to get expensive when you get into your late 60s, early 70s. And if there's not enough time for people to get funding in above and beyond the expenses that can grow and compound, the expenses are going to outpace the growth, especially if not everything works perfectly, which it rarely does. So in those situations, there's a lot of peace of mind in whole life, knowing exactly what that payment is going to be and that it's not going to go up, and you don't risk losing the insurance. So if you have an underlying insurance that continues to increase and you have no guarantees that your cash is going to grow and keep pace with it, which we don't have those guarantees inside of an IUL. That's one of the risks that we take on when we choose the IUL. That might be too much risk for a client. And even when we like our blended designs, we talk about the high cash value specially designed policies. Those are usually either a base of whole life blended with term insurance, annual renewable term, or it could be a base of annual renewable term blended with cheaper non-commissionable term. But either way, we're blending in this annual renewable term insurance. The older somebody gets, the higher the risk of carrying that annual renewable term insurance into 70, 80, 90 years old. If your client is already in their late 60s, we might not even want to do any blend, even using a whole life in that scenario.
One other thing that I think about is it sort of ties that later phase. So even though I'm on the younger side, as I think to when I get a bit older, by having these different buckets of whole life and IUL, the way that we access that for retirement supplementation is actually a bit different too. And that's where, in some ways, there's some advantages to how an IUL works, having that arbitrage or possible arbitrage in policy versus with whole life. We're going to tend to always go with withdraw up to your tax basis, where the premiums that you've paid in, you withdraw up to that tax basis, and then you might start taking policy loans if you want to access those to supplement your retirement income. With an IUL, there is that option to borrow against the policy and have arbitrage while drawing in retirement. That's sort of disconnected from a lot of the insurance cost aspects that James was talking about, but I think in those later years, how we access those funds is a little bit different in these. It's not necessarily one's better than the other, but I think that when you think about how IUL can supplement retirement income with that possible arbitrage, but also, my own policy, I have the option to go with a safer, if I want to not do the indexed or participating loan, I can do a normal kind of wash loan similar to what you have in whole life. So the two different loan structures is another thing that is interesting with an IUL policy. And there's, maybe there's some aspects with some whole life carriers that are out there, but it tends to be that that's not the case. They're not going to have that.
That gives me a thought. Each of us own specific policies. I own both whole life and IUL. No, Carlo, you own both. Jing, you currently just have an IUL. How about telling us how you decided? What was your decision point? Why you chose the products that you did when you did?
Yeah, I mentioned this briefly. I think for me, when I was shopping around, I'll decide which one I need to go. I compare side by side, right? This is the same funding, and then just optimize design, whole life versus IUL. I can see, although I'm not in my 20s, but I still have a pretty sizable 40 something years for the cash to accumulate. And then the purpose for that policy is to dump the money in and put money as much as I can so I can earn that arbitrage. If I do real estate, say it's 15% cash on cash, I'm only paying 5% to the insurance company. The money is working for me. So I think for me, like I mentioned, I don't want the cost of insurance. I know I will not get the perfect rating. So that's a pretty easy determined factor. But down the road, I do want to probably own a small whole life policy, especially we all talking about the flexibility of Guardian. I think the best way to explain to the client is to have it so you practice, you know what's going on, and you can share with the client. So for me, it's a no-brainer for the purpose of what I want to do to own an IUL.
That makes me think. You mentioned, and this is going to come up with clients as well. You mentioned that you expect that you may want a small whole life policy in the future, presumably to meet a death benefit that you definitely want to give away. Have you purchased any convertible term insurance yet? Or is that on the schedule for you? So that way you know, especially where your health is at now, you'd lock in that health rating and you don't have to worry about not qualifying at some point in the future when you do want to add that whole life policy.
I do have two terms. One is with AIG, one's with the principal. I do believe both are convertible. When I'm ready to really fund a small policy, I probably will not be able to fund another sizable whole life. I'll probably take a look the option what they have for both for each of the term insurance.
You are prepared in that case. If your health changes, you have some convertible term options. That's great. Carlo, how about you? You own a couple of different policies. How did you decide when to get which one?
So when I first discovered this concept, I discovered a number of different content creators out there, and a lot of them were all about using whole life for the infinite banking concept. That is where my head was at initially as I came into this process, and that's where I honed in on getting my first policy is a whole life policy. When I actually encountered James and started watching his content and actually met with him, I started to be like, oh, well, I think both of these things are good. I want to put both in force on myself, but I really just started the process of whole life. So there wasn't like this really, I needed to go whole life first. That's what I ended up doing. It wasn't the completely deliberate decision, but I put that one in force first. I think it's overall, if I was to go back and think about it, I probably would have gone with just based on my age, I probably would have gone with a slightly smaller policy for that whole life.
Can I ask you a question? When you bought your first policy, that was before we met, did that agent have a proper discussion with you as to which product might best meet your need? Or did you go into them and say, this is what I want, and that's what they gave you?
Prior to meeting with James, I met with my family member who was able to get me an illustration. And what they showed me as I was discovering this concept, it was really bad. And I was just like, oh, why would this doesn't make any sense for me to do. And I look at all the numbers of all of the different things, it was really bad. So what I learned from that, and then later meeting with James and encountering some of the things that he showed me with this, it was a completely different ballgame. The designs that we do are different from what normal agents will do. And people don't know, they don't know that they're putting out a bad design oftentimes. So it's not this person's fault or anything like that. It's just that they weren't taught how to design properly. So when I went to put the whole life policy in force, it was an optimized design. And when I had seen things prior to really working with James and learning these things myself and going into this business, it is a completely different thing from how we design policies. And it is a really big difference. Some of my videos, I go into some of those comparisons of these bad designs. And I think James has videos on this too. When you look at the difference between an optimized design policy and really regular, normal whole life policies, you're talking about giant commission differences and all of that. And that's coming out of your pocket if you're a client. So that's a big factor. And generally speaking, I think both IUL and whole life can look really bad if you don't get a proper design. So make sure you're looking for somebody who is specializing in high cash value designs. That's really the main thing. I like both products.
So you started with whole life, And then what was the next policy you bought and why?
So I went with an IUL as the next policy, and the applications went in similar timeframes. One other thing to also consider is that I put in another application for another whole life policy because I had wanted one, and it was with Guardian, and I didn't get a favorable health rating on that. I had top health rating on both my whole life and my IUL. A particular condition I have did not align with Guardian's underwriting process, and I was offered standard. And that for me just wasn't appealing. That's why I didn't move forward with that. But as you move through this process, you can look to also do the same thing or something similar where you're looking at a number of carriers at once, and then you can kind of move forward with whichever one that makes the most sense for you. So I put an IUL policy in force within a couple of months of my whole life policy going in force.
So I also own both. I came into this with specific plans. And essentially, where I was starting out and with where our finances were at and our savings level, whole life made a lot of sense to me. I was also enamored with the infinite banking concept. I'd been doing a lot of research on that. I didn't have any aversion to IUL in that case, even though most of your infinite banking practitioners are going to really say, whole life is what you need to do that in. But the reason I went with whole life is just because of the safety aspect of it. I have a wealth pyramid that I talk about, and I've got some videos on it. And when we talk about a wealth pyramid, our base needs to be a solid financial base. And with what I had, as far as meeting that financial base, I was not in a good position. Let's put it that way. I was not in a good position. I needed as much safety as possible. So since I was planning on starting a very large policy, actually multiple policies, I decided to go with some large whole life policies, knowing that I'm going to be putting a lot of money into these things and I want that guaranteed growth. And I was also planning to borrow from them and do other things. So the risk I was going to take is going to be outside the policy, not inside the policy. So I wanted less risk inside the policy. Now, those were my big life insurance policies. Actually, now that I'm talking about this, I actually started with a small IUL first. My first policy was a small IUL. And the reason that I went with a small IUL first is because when I first got into this industry, that was what I was selling. That was what we were basically taught. And it's a good product. There's nothing wrong with it. It's a good product. I wasn't planning on getting a big product. It wasn't very risky at the level that I'm buying into it. And so it worked fine for what I did. And at the funding level that I was at, I really didn't have to take all these other things into consideration where my finances and things were at. It was just a small amount of my budget. So small amount of my budget, didn't really worry about it. It's a small policy. The first slightly bigger policy was actually my Mass Mutual. The reason I got that one was because of their dividend rates. Mass Mutual has really good stated dividend rates. Now, dividend rates don't tell the whole story. The claimed dividend rate that the carriers put out each year doesn't tell you the whole story. But I didn't know that at the time. I just thought, you know what? I like that number. It's consistent. It looks like a good product. I'm going to get that product. And I could design it. It's a slightly larger policy than my IUL and a lot less flexible, but it has that safety aspect to it as well. And so I picked up that policy before I really jumped in and took on some large policies. The order of operations essentially was small and safe or large and safe. And then we moved into IULs from there. And my IULs do carry a considerable mech space, the ability for me to put a lot of money into those things, but they represent a higher level of risk. So I did those afterwards. I did those after I actually got a few years into my whole life policies that are really heavily funded. So I got to build up that nice safe base, and then we add on some risk. Any other thoughts from you guys on your policies, or if you have questions that you bring up to your clients to help you decide which to get?
So I was just going to add, I think that some of those similar factors, when I funded my whole life heavily, was also with this idea that I was going to fund the IUL. And as you get closer, so one great thing about both of these things is that when you don't lose access to the funds, when you have the ability to borrow against the funds, you can drastically increase your savings rate. And the people in the FIRE movement, I talk about that in some of my videos pretty often, the financial independence, retire early movement. But really, when you think about any of that, achieving financial independence, it comes down to your savings rate. And so one great thing about both of these products is that we can have a very high savings rate. It's not like tying up funds in penalty qualified accounts, right? When you have penalties to access your funds, that is a really something that you have to overcome if you ever need to access them. But my savings rate is extremely high, and that is really because the majority of that is going into, I do have retirement accounts. I'm funding my retirement accounts similar to the traditional retirement numbers. A healthy portion of a percentage of my income is going to those things, but a bigger percentage is going into my permanent life insurance, my high cash value life insurance, because I can really drastically increase my savings rate, knowing that, oh, if I need to finance this thing, even for my personal things, I mean, I try to mostly use the loans against them to do cash flowing activities, but knowing that I can use them for financing other things is also a powerful thing.
I want to add a little bit about the kids policy, right? There's a lot of YouTubers and agents talking about baby millionaire and substitute of 529 plan. But I want to ask our audience to really think the underlying purpose of whole life or IUL or any kind of life insurance. We have to insure ourselves first, right? We have to, because we are the one earning money, and then we can fund the policy. The insurance, the purpose of the insurance is for something happen, your house will not be foreclosed, and then your loved ones, your next generation can have a sizable proceeding to use. I think there's a lot of encouragement to buy for the kids to be a millionaire, fund it. But I think we all should think about how we should ensure our insurability and how we fund our policies and how you put those different policies into our own asset as a permanent assets.
Good points. Let's tie a bow on this topic, at least for today. We're going to come back in the next couple of weeks and we're going to talk about specific concepts and how you might use whole life or IUL. Is there anything that you, Jing or Carlo, want the listener to remember from today's topic?
For me, I want my client to really know and learn as much as they can. It should not be the interest of the agent. It should be what is best for you, for your family, for your beneficiaries. What the main purpose of this particular policy or multiple policies you want to purchase and how you want to manage it. The more you know, the more you can best utilize those policies as they will be your assets, and they may take some management, but the more you know as the owner of those policies, the better down the road to best utilize those policies.
I briefly mentioned this earlier, but I think that this is worth repeating. The major factor when it comes to these things, I think both whole life and IUL are great. The biggest factor is getting a properly designed one. And there's so many ways and so many agents out there that are not going to get you a policy that is designed for cash value growth. So I think that that's the biggest thing, is ensure that if you look at an illustration from an agent and it doesn't seem to line up with maybe what you've seen in my videos or James's videos or other videos that are out there, then look to find somebody who can get you an illustration that's closer in line with that, so that cash value growth will happen whether it's an IUL or a whole life policy.
Good points, both you guys. The education is key. That's the whole point of why we're doing this, so that the client can help themselves to make the right choices, right? We have different products to choose from, different carriers. There's different designs that can be done. Ultimately, it's up to the client to figure out what is going to work best for them, and not necessarily just let the insurance agent convince you to buy a particular product. Because if you don't have the education, you don't know if you're buying a product that best benefits you or best benefits them. So design and education, really important so that you make sure that you're making the right choices. Certainly, I think if they're meeting with any of us, they're going to get some good counsel. They're going to get some good advice. I know a lot of times when I'm meeting with clients, I will often tell them my number one goal here is to educate you on these products so that you can decide how big to make it, how they work. You want to be able to manage it in the future, just in case something happens to the insurance agent and they're not there to remind you what the plan was when you first started it, how these things work constantly. Now, you don't have to know them ins and outs like we do, but it helps to know the basics so that you can manage it properly. Does that sum it up pretty good?
Yeah.
That's great.
So your call to action this week, Mr. and Mrs. Listener, is take a look at your finances. Maybe you can try to identify where you have some financial gaps, or maybe you want some help. You can contact one of us. We can certainly help you understand where those might be at. I'm James Barber, your Oregon Cash Flow Pro. You can find me on YouTube at Oregon Cash Flow Pro.
This is Jane with Tax Exempt Millionaire Club.
And I'm Carlo Vaquera. You can find me at netwealthfinance.com or on YouTube at Shapnin, or SHAPNIN.
And we are licensed to work with clients across the country. We'll be back next week.